Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about preparing your investments for 2020. We've had a lot of clients come in the office and ask, what can we expect in our investments, in our 401k and our retirement plans for 2020, or do we need to make some changes? So what we're going to look at today is potential changes that are going to happen in 2020. Some of them will happen. Some are speculation that people believe might happen. But the number one thing we're going to talk about right now is going into 2020 is the election year. And this one always piques my interest, looking back to see how markets have performed during election years. And we listen over the last year or so, and people will come in and say, well, if a Democrat gets in, the market's going to crash. If a Republican gets in, the market's going to crash, or it's going to go up, whatever. They have these preconceived ideas as to what's going to happen. We understand that politics now are significantly different than they were before. The social media part of it, the instantaneous news, and we probably have two parties that have a divide that's deeper than it's ever been. But we're also going to look back to see how markets have performed in the past when it comes to election years. That's one thing we're going to talk about. Then we're going to go into other things and talk about just some of the basics, the business cycle and interest rates and possibility of recession and things like that. And we'll give you some tips and ideas on how you can position your investments for this upcoming year. But let's look at the first one, 2020, and look at the election year and how the presidential election could affect your investments. Tyler, let's talk a little bit about what we see here.
Yeah, Dean. So with us nearing the end of 2019, we're coming up on December, so about one more month left where everyone's trying to get their last year-end financials in order before 2020 rolls around. When we look ahead in 2020, the number one thing that comes to mind for people is it being an election year. And with it being an election year, typically people are usually up in arms and they're concerned about the market and the economy and what's going on politically, because whenever an election year comes around, obviously there's the potential for change and uncertainty. And oftentimes when we talk about the stock market, if there's two things the market doesn't like, it's exactly that, the potential for change and uncertainty, which is what an election will bring. Now, we have some statistics here that shows how the market fluctuates regardless of who gets elected. So you have people on both sides. You have people who are very moderate, who all the time, they're concerned and they oftentimes they make a knee-jerk reaction and they overreact during election years, where they take their 401k and they put it all into money market positions, or they cash out their IRAs. And we're not saying to do anything at all like that, but more so just show different statistics of what happened in the past. So if we go back, there was 23 election years going all the way back since 1928 for the S&P 500 stock market. So going back to 1928, that is 23 election years. And during those 23 election years since 1928, there was 4 that were negative and 19 that were positive. Again, only 4 were negative, 19 were positive. So again, past performance doesn't mean future results, but past gives us a pretty good indicator of what can happen. And the last negative years the last negative election years. There was 2 somewhat recently. One was in 2008, when the market in 2008 was down 37%. That was the Obama and McCain election. And then before that was the year 2000, where the market was down 9%. That was the Bush and Gore election. So just recently, those were the two. Now, before 2000, the last negative election year that we had was going all the way back to 1940. So everywhere in between there, every time there was an election year, the market was positive and going in the right direction. But more recently, in 2008 and 2000, I want to talk about those real quick because those were the last two where they were negative. In 2008, the market was down 37%. But that wasn't due to an election year alone or Obama being elected president. That was due to our housing crash that was going on at that time, where that was the housing bubble had burst. There was many banks lending out subprime mortgages to underqualified borrowers. They couldn't pay back the debt. That led to banks going under. It led to the government having to bail them out, and it led to the economy going down. So that 2008 crash was completely separate of the election. And same thing with 2000, the Bush versus Gore election in 2000, the market was down 9%. Well, in 2001 and 2002, it went down even more, and that was during the dot-com bubble. That's where all the tech companies that were going and having these IPOs and going public, all of them crashed. That led to the overall market going down as well. So the two of the four negative years, the most recent two, neither of them were down solely due to the election. It was mainly due to different economic circumstances.
Okay, Tyler, I'm going to throw something else in there too. So you talked about the most recent two downturns during the elections. And again, it was something to do more with economics than it had to do with an election year. But the previous two that Tyler referred to also was 1940 and 1932. The 1932 was during the Great Depression era also. So again, you start to see where we're going with this, and that is it's not so much the person that comes in during the election or goes out during the election. It has more to do with the underlying economy and how it's performing at that particular time.
Good point there, Dean. And that's very true, and that's something that we might see in 2020 as well, where usually what happens is the market, as election gets closer, so over the summer months and into the fall before election, that's when we see a lot of volatility. But moving forward, I think pretty much everyone can admit that politics today are a lot different than what they were in the past. So again, candidates have a lot of different extremes in today's day and age as well. So that, it could be different moving forward. But if we go back and we look at almost 100 years, or basically over 90 years, 91 years of past performance based on election years, it tells us that regardless of who gets elected, typically the market has gone up. However, it can go down as well based on the underlying economy. And something that we're going to get into today as well is the, a possible bubble or a possible recession that could be on the horizon, and that might affect the market as well, regardless of if President Trump were to get reelected or if a Democrat were to get in. So when it comes to 2020 being an election year, that's the number one thing that many people think of. That's one of the top things that we are watching as well as financial advisors and financial planners. But ultimately, the stock market, it will typically be volatile as it has been. It's going to go up, it's going to go down. But in the past, regardless of who gets in, usually the election itself won't affect the market as much as the underlying economic conditions will.
Okay, Tyler, good points. Okay, so 2020, we talked about the election. Now let's look at things that are a little bit more skewed towards the economy itself, the health of the economy, or the lack thereof. And the next thing we can look at is it looks like we're going to continue to see a declining interest rate environment in 2020. We have seen the Federal Reserve start to drop interest rates a little bit. And for those people who have debt, they do like the idea that interest rates decrease because the money they have to pay back typically is at a cheaper rate. However, those people who are saving and looking to make and maximize their gains through fixed interest vehicles like CDs or fixed annuities, treasuries, and things like that, they don't like the idea that interest rates are decreasing. So what you need to do is look at the situation. It does look like we're going to have a declining interest rate environment. Those things do affect investments such as preferred stocks, which are interest rate sensitive. They also affect things such as bonds, and the yield of bonds. So you need to be aware and look at your portfolio. Have it reviewed by your financial advisor. If you don't have a financial advisor and you want a second opinion, stop in our office. We'd be happy to give you a complimentary second opinion. But do understand, interest rates do also have an effect on certain investments. There are real estate investment trusts that are also interest rate sensitive. Now, those have been on a nice run here lately, but it's something that you have to be aware of, that you might have to change some of the holdings in your portfolio. Tyler, anything else that we should talk about when it comes to interest rates?
Yeah, so the other thing to look at as 2020 rolls around is the, like you mentioned, Dean, the interest rate environment. And in 2019, up until late July, interest rates were actually slowly increasing, and then in July, the Federal Reserve decreased interest rates slightly, and since then, interest rates have actually been going back down a little bit. So when it comes to looking forward to 2020, some things that you could do when interest rates are going down, potentially look to refinance debt at a lower interest rate. So there's many people that they might have homes that are on 30-year fixed rate loans. You might want to look at refinancing at a lower rate if they continue to decrease into 2020. But then again, when it comes to people who have money in money market accounts, savings, CDs, fixed rate annuities, that's not going to help you too much when rates are going down, because your rate that you're going to get saving money on interest is going to go down as well. So with interest rates going down, you might want to look and try and reposition some funds into some dividend paying stocks if that suits your risk tolerance, because again, with the CDs and fixed rate annuities and cash, you're not going to get a whole lot of interest when interest rates are going down at the point that they're at right now. But at the same time, usually when interest rates go down, the stock market likes that, because there's plenty of big companies and they borrow money every single day. And there's companies that borrow millions of dollars every day, and they're paying such a low rate that they can then turn that around and grow that money. But if rates were to increase, that's probably a bad thing for the market, because then these companies are not going to borrow as much. Therefore, they're not going to spend as much and stimulate the economy as much. So with interest rates going down, look to see if you can try and take advantage of that and refinance debt at a lower rate in 2020. However, with your investments, for those people who are saving, who have money in savings accounts, CDs, annuities, whenever interest rates go down, it's probably not as promising for those folks who are saving money.
Okay. The next one we're going to talk about is when we're looking at the year 2020 and things that you have to be aware of is the business cycle. Now, the business cycle is nothing more than the natural way that you see peaks and valleys that our economy works. It's historical. It happens all the time. For instance, when we came out of the recession in 2008, 2009 started the upward trend, which we refer to as growth. And you can sort of imagine this as the line starts going up. That shows growth. We've been on a tremendous run here since 2009. However, some analysts and economists are saying that we have peaked. And what that means is we have reached our peak as far as the market may be concerned. The economy may be concerned. You hear people talking about the market or the economy is overheated. It is strong, but it looks as though we have come over peak. We've gone over the peak, and we started just on the backside of the peak. As you start going down, what that refers to is recession or retraction, and some people have talked about the possibility of a recession coming up. We talked about this on a show a couple of weeks back. Too many people show significant concern that a recession turns into depression. Doesn't always happen that way. Many times recessions are not called a recession until 2 or 3 years later, when analysts look at it and say, well, we actually hit recessionary numbers there. So again, many times the recession isn't as deep as people paint it. People refer to 2008 as the Great Recession, but you have to be careful there too, because it was a perfect storm. There was so many other things happening at that time. It was not just a recession. It was a mortgage industry collapse. It was a financial industry collapse. We were bailing out the likes of General Motors and AIG and Citibank and things like that. So, I mean, there were a lot of things happening at that particular time other than just recessionary numbers. But getting back to, the business cycle, as you start going down, it could be recessionary or a retraction. And once you hit the bottom, it could be a very deep trough, which could be depression. It might not be a deep trough at all. And one thing that I tell people, there's light at the end of the tunnel when you're looking at recession and, unfortunately, even depression, is you start the business cycle all over again, which goes into growth. So we have to be aware right now, as far as the business cycle is concerned, it looks like we are off peak and are starting to come down in the business cycle. And what that means to your investments is you need to look at things that are better suited for that time of the business cycle in your portfolio. Things like consumer staples. And Tyler and I are not here to make recommendations, but consumer staples are companies that you're probably familiar with. Procter & Gamble, the Clorox Company, Church & Dwight. They're the manufacturer of Arm & Hammer or First Step kitty litter. I mean, that is definitely consumer staples. You might look at utilities, okay, things like that. You might look at defensive stocks, such as some of the tobacco companies, even some of the beverage companies. If people get into recessionary times, they still have enough money to go out and buy a beer or two. So those are some of the investments you need to look at. Many times consumer discretionary and tech start to slow down, and we've seen that. We've seen the FANG stocks that carried the market the last couple of years to become relatively stagnant in 2019. Amazon and Facebook, Google, Netflix has still had, a nice run, and Apple has too, but it's really, really slowed down compared to previous years. Tyler, what else should we talk about when it comes to the business cycle?
Yeah, Dean. So I know you touched on that pretty good, but when it comes to the business cycle, as you mentioned, a lot of analysts are looking at potentially going into a recession, whether it be 2020, 2021. But in the near future, it's something that this growth trend should be slowing down. That's something that a lot of people and analysts are saying. And as you mentioned, one of the main things that we tell clients is to look at a lot of the more defensive stocks, like you mentioned, your Procter & Gamble, Clorox, Johnson & Johnson. But then in addition to that, consumer staples and utilities are also a couple different sectors that many people look at whenever we're going into a retraction or a recession. And it's simply moving away from the growth, and that your growth stocks are a lot of tech and possibly pharmaceuticals or healthcare, and shifting more defensively. So as you mentioned, Dean, your tech companies, the FANG stocks, Facebook, Amazon, Apple, Netflix, Google, a lot of those companies, usually those are the ones that get hit the hardest during a recession because they've had the biggest run up. And whenever you have a recession, the ones that have the most growth are usually the ones that encounter the downward territory first. So we often recommend, whenever there's talk about a retraction or a recession, and if there's actually different economic indicators that are telling us that it could very well happen, then oftentimes we like to shift more so from growth into value. And again, those are the companies that you're going to find in the defensive sectors, consumer staples, and utilities. So something to look at come 2020, but the business cycle that we're in right now should be trending down within the next couple years. So you might want to pay attention to that and potentially talk about shifting some of your portfolio from growth into more value.
Good points, Tyler. Before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the next topic we're going to talk about when we're looking at 2020 and beyond and preparing your investments or your portfolio is, are there possible bubbles on the horizon? Okay, and what that means is, you've heard people refer to this over the years. A bubble is something that is ready to burst, and it relates to certain business segments in our industry. So for instance, in 2008, The housing market was so hot, it was overheated, it was a bubble, and unfortunately it did burst. Well, some of the bubbles that we're looking at right now is potentially tech. And what I mean by tech is tech stocks are very hot. Some people say, they're overvalued. However, there are certain tech stocks that if you're waiting for them to fall and be able to buy, that doesn't happen that often, such as Amazon, and you look at Apple and even Microsoft. However, what's happening as we go into the year 2020, we're paring back a little bit on tech. We believe that, again, based on the business cycle, tech might start to slow down a little bit. We're taking significant gains for our clients, moving them over, and what we're doing is buying a little bit more defensive going into 2020. And we're still buying some industrials, the likes of Honeywell and things like that. But tech is one of the bubbles that we're watching. Also, there's a bit of talk about corporate debt becoming a bubble. Corporate debt has been wonderful to accumulate for these companies over the last couple of years because interest rates have been low. So they call it easy or cheap money. So we are watching that. That's where you don't want to have all of your eggs in one basket. You don't want to go heavy on any one particular stock position, because if that company tends to get into a situation where they have to repay a significant amount of the cheap and easy money that they had due to low interest rates, you might find that stock suffer as a result. Tyler, what other type of bubbles are we potentially looking at?
Yeah, so moving into 2020, as you mentioned, Dean, some of the bubbles, one of the major ones being a potential tech bubble, where when people talk about tech being overvalued, that means and I've heard different analysts talk about this, where there's too much money in different tech stocks. So if there's talk of a recession, or if recessionary signs were to show in 2020, then usually what happens is tech is one of these sectors that gets sold off the most. People jump ship and shift their money from tech into cash or into different defensive stocks first. Therefore, it leads to all the money pouring out of those stocks, and the bubble bursts, and those stock prices lose a ton of money. They go straight downward. So tech bubble is one of them, just because of all the money that's pouring into the tech sector. Part of the reason why is many people suspect that different tech companies are ones that provide the most growth potential over the next 5, 10, 15, 20 years. And in the way that we're moving as a country and as a world, that's it's very true, where the tech sector probably does offer the most growth, but whenever there's talk of a recession, or if a recession were to happen, it's going to be the one that gets hit first and the hardest. So if that were to happen, that bubble could burst that way. Another big one would be student loan debt is another potential bubble that everyone is watching, because right now there's so much student loan debt that people are incurring. And what we've noticed is a lot of younger folks that are coming out of college, when they're strapped with this student loan debt, it becomes an anchor on consumer spending. So that can hurt the economy, because you don't have these younger people who are instead using money to buy a house earlier, or a car, or put money on a credit card and just go out and spend money. Instead of doing that, they're strapped and they're paying down loans instead of spending and stimulating the economy. So that's something that could lead to a recession, or could only magnify a recession, is if this student loan debt bubble bursts. And if eventually that were to happen and this debt isn't paid, then the federal deficit increases, because the government, when they're lending these student loans, if they're not getting paid back, it's only going to hurt the deficit. So that's something that we're looking at, potential tech bubble, student loan debt. For any people out there who do have student loans, knock those out as soon as you can. You don't want to carry those around with you. So have a payment plan, sit down, budget, and try and get those student loans paid off as soon as you can. The other one, there's potential talk of another housing bubble. Now, we don't see anything like 2008 happening again, just because banks aren't lending out these subprime mortgages anymore, and there's actually regulations where many of them can't. They legally can't do that based on what happened back in 2008. But the housing market is very hot right now. It is at a high point, so that's something to look at. It might be a good time to buy. If the bubble were to, or if the market were to go down, if we were to have a little recession, usually that helps people who want to buy, not as much people who want to sell. But tech, housing, and student loan debt, those are some bubbles to watch. If we were to have a recession, pay attention to those sectors because they could go down in 2020.
Okay, good points, Tyler. Now let's talk about trade. Okay, so we're looking at are your investments ready for 2020? Well, if you look at the majority of this year, when the terms such as tariffs and sanctions have come out, there's been a lot of talk with China, most specifically, to get a trade deal done. And a lot of the growth that we've seen in the second half of the year has been based on optimism that a trade deal would be done. So when you hear analysts talk about, a lot of the market has already built in a potential trade deal, that means they're referring to the growth you've received already in the market is based on a lot of hearsay that the trade deal is going to be done. So one thing that you need to be aware of is if a trade deal isn't done, you might see a significant market slip. In other words, all of the built-in growth is potentially going to be at risk if we don't get a trade deal done with China, most specifically. So how can you look at your investments and see if you are too heavy based on some of the trade growth? Well, look at, if you're holding individual stocks, look to see where most of them are, the products or services are either manufactured or sold. For instance, Apple comes to mind. People talk about Apple growing this year. A lot of it has to do based on the enthusiasm that a potential deal could be done with China. Why? Because a lot of the manufacturing and distribution and sales of Apple products happen over there. That happens with many products and services. So until a deal is done, you might want to look at diversifying a little bit more and look at a little bit more domestic investments as opposed to international or emerging markets. The other thing, too, is there's the USMCA that has been on the table for some time, and for all intents and purposes is just sitting out there in limbo until the impeachment process looks like it's done, which is an absolute shame because there's some significant trade opportunities for the United States, which will help bolster continued growth. So trade is a concern going into 2020. Our country has turned from a unilateral trade policy into a bilateral trade policy. So we're now into negotiating typically deals one-on-one with other countries versus pooling our efforts with certain regions or continents and going into trade deals that way. So it takes more time to put these trade deals in place. But trade is a concern as we look towards 2020. It could make the year, it could break the year.
Yeah, good point there, Dean. And the only last thing that I'll add with trade before we close is just that pay attention to it come 2020. It's kind of the number one thing driving the market in 2020, the U.S. and China. If you hear the news that we do get a trade deal done, it's probably going to be a good thing for the stock market. If not, if trade talks head south, probably going to be a bad thing. So that's the number one thing driving the market. Hopefully the U.S. and China can come to terms on a good and fair trade deal.
All right, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.